I think stablecoins, if you ask my grandma what she thinks she has, she looks at it as a bank deposit. So if we believe stablecoin matches end user expectation, stablecoins will end up being regulated like banks. And I think we're just in that discovery process until we get to that point. Yep. So when I looked at stablecoins in 2020, I was like, this is like a tokenized bank deposit. And when rates started going up, I was like, how am I getting yield on my Marcus account that is higher than what I'm getting on USDC on Aave, for example? And the difference was like 2% versus 0.5% on Aave. And then I was like, we have to go after this opportunity. There has to be a yield-bearing stablecoin, and the experience has to be a stablecoin experience because the product is a stablecoin.
Welcome back to The Signal, folks. Today, we are talking about arguably the killer use case for crypto, stablecoins. In just a few short years, stablecoins have gone from a pretty niche product to a pretty significant thing, paving crypto adoption in both developing markets and developed markets now, with institutional adoption playing a significant role. Circle and Tether, of course, are names that have probably been on everyone's tongue. They're leading the charge with currently about $30 and $120 billion in outstanding supply, respectively. But the thing is that while these companies are making serious money from the underlying T-bills, users, specifically holders, aren't seeing any of that value. So today, really excited to be joined by Martin Carrica from Mountain Protocol, and we'll be discussing how they plan to shake up that stablecoin space by giving users access to stablecoins that actually work for them with the first permissionless yield-bearing stablecoin. So Martin, welcome to the pod. It's great to have you on.
Thank you, guys. Thank you for having me, and looking forward to this conversation.
Fantastic. Yeah, Martin, maybe just to kick it off a little bit, we'd love for you to just share a little bit of your background, your interest in crypto. We're going to get into, I think, a lot of deep discussion on sort of boots on the ground in Argentina and the impact that crypto is having there, and also get into Mountain. But maybe just to start off, like, what brought you into crypto? What makes you interested in this space?
Awesome. So Argentinian, that's the accent that you're hearing. I come from a small town in Argentina, moved to Buenos Aires to do my undergrad. I studied engineering. And in our undergrad, they push us a lot to get work experience while you're still studying. So my first internship, you do the internships not like in the US where you do it in the summer, you do them while you're studying, like during the career. And we all, like all of my friends and I got jobs kind of like early on. And the peso inflation at that time was around like 60 to 70%, right? So higher than it is now, but a lot lower than the 300% from Q4 last year, right? So when the election happened, inflation in Q4 was 300. So this is the first time in my life that I've seen Argentinian inflation, like in my adult life, below kind of like the 40% digits. It's now with Milei, and we're going to talk about him in a second. But let's backtrack into kind of like us getting the first salaries. There were essentially, if you wanted to protect yourself from inflation, you have two options. You can either go in person and buy paper dollar currency, and then do something with that paper. That's called the blue market, the caves, which I think many people have talked about. The Tucker Carlson visited some and so on. And then the other option was to buy Bitcoin. And we were all engineers, and Bitcoin was a thing in our university. This was circa 2011. And we're like, hey, let's buy Bitcoin. It's kind of like flat versus the peso, right? Like you had volatility, but it was kind of flat. So we'll go and buy this token. And it was easy because we could move it. Some of us had accounts in the US, so you could find a way to get your money into the US and spend it and so on. So that was our introduction to crypto was, hey, here is a way for Argentina. China was the big market at the time, right? So unlike today where you see Ether gas prices go up in like the workday in the US, at that time, all the action happened in our night, which was China's trading day. So it was like a China, Turkey, Argentina kind of story back in 2011. And yeah, we all went, bought Bitcoin. That was like the stable coin for us. And it was interesting because there were no exchanges at the time. Coinbase hadn't started. Mt. Gox started a little bit thereafter. So we would buy from miners, which was a very, very interesting experience. And for me, it was kind of like this is very cool because I can buy this asset. We can self-custody it. Self-custody was a little bit harder at that time. You didn't have a lot of the tools that you have today. But I was like, there's no way my mom is ever going to buy this. Too volatile, too complex to handle. So I didn't get completely peeled at that time. It was like, okay, this is a good niche product. It allows us to trade, barter between some of these emerging economies. I then went into traditional banking. So I did works with banks. This was still the 2008 crisis. All the aftermath was still happening. So I worked in receiverships, a lot of like risks. A bunch of the banks were failing their capital test requirements. So supporting that. So very familiar with things that go wrong in the traditional banking space. And then I saw stablecoins. Stablecoins happened 2 cycles later, kind of circa 2020. And I was like, okay, now this is really interesting because now you have all of the advantages which made us buy Bitcoin at the time, but with a stable asset that my mom can actually purchase. And you saw stablecoins kind of start picking up in Argentina very, very fast. The pandemic, of course, helped because the cueva now was in person. You couldn't leave your house. So suddenly stablecoins were the only way to dollarize. And again, inflation, 80%, people escaping the Argentinian peso. Stablecoins started to pick up like crazy. And I was like, okay, this is it. This is the future of a system that I knew with a completely new technology that gives you a lot of benefits. We can talk about them in a bit. And that's why I went deep into stablecoins and now Mountain.
Fantastic.
Sorry for the long intro.
No, I love to hear it. Love to hear it. And yeah, going back to 2011, you're definitely an OG in the space. Pre Mount Gox is definitely gets that status. So I think it'd be good to sort of maybe dive into this like kind of boots on the ground perspective in Argentina a little bit. I'm over here in the States, Oscari's in Europe. I think if you talk about crypto over here in the States, anyways, with the average person, hard for them to really see like the value prop of some of this. And in some ways, I think, we have a pretty stable currency over here. The government's never defaulted on the debt. This is not the case over in Argentina, which is a G20 nation. I think one of the largest economies in South America, Latin America. And, you've had a government default, I think, over 9 times. So I'm curious, is crypto sort of like intuitive for Argentinians? Can you speak a little bit to just like when somebody learns about crypto over there, like what is that path or that path to sort of understanding it take?
Yeah. Yeah. So I'm going to talk about 2 things in which you discover crypto. The retail story, which is very much Argentinian, and then kind of like the euro dollar story, which I think is more enterprise and more global. Many Argentinians participate here, but many other countries also do. So the big crypto story of Argentina is very retail. Argentinians are used to the lack of discipline of the central bank, right? So the Central Bank of Argentina is very much not independent, and it is and historically it has always closed the closed the budget by printing, right? Because Argentina doesn't have very good access to credit. Because of those 9 defaults, no one wants to lend money to Argentina. Raising taxes is very hard. So the only other lever that the government has to close the budget is printing money, essentially. And that has happened over and over and over. And we've seen, I think since my grandma arrived to Argentina in the 40s to now, I think we removed like 9 zeros to the currency. So like it is I don't know if we can say this word, but like total shitcoins, right? Like we've changed like so many names and types of currencies. And today, if you go to Argentina, the biggest bill is like $1, right? So you're going to pay something, the biggest paper bill is $1. So Argentinians are very well trained into escaping the holding of a shitcoin. And the easiest way to do that is moving to the US dollar. Why is that? In crypto, I think we all know that the US dollar gets devalued, but from a fiat perspective, it usually gets devalued the least, right? So it's the least worst currency that you can get from a Forex perspective without getting into being an investor. And I think like getting into equities, getting into gold, like if my grandma needs to do something, the dollar is the simplest way of getting into something that doesn't require any kind of due diligence and so on. So my grandma, she gets her retirement money, she buys dollars. My mom does the same. So it's a very democratized thing. It's not just like the 1% of the elites. And it is crazy because you talk about carry trade, interest rates, high yield checking accounts, like all of those things that in the US most people don't actually do. My grandma understands those things. She understands that if she trades to dollars, she's giving up the interest that like she could get in a CD, like a certificate of deposit or a high yield checking account in pesos, but then she's exposed to the forex risk. And she's thinking like, what do you think is going to happen? Is the dollar going to be devalued now? Yes or no? And like my grandma's thinking about that, right? And she doesn't have any. I think she finished high school. That's all she did, right? So she came in the 40s. So like everyone knows about those things. So very good CFOs coming out of Argentina because of this, having to think about the time value of money all the time. So stablecoins are when you think about dollarizing and you say, okay, now you have a dollar that exists on crypto, people at the beginning were a little bit more nervous about this. So you saw more of the import-export business use case come up first. But once USDT and Tron started becoming accepted in the cuevas, and especially with the pandemic, right, where a lot of the dollar transactions became remote, and most of these cueveros of this like black market started accepting your dollar, suddenly a USDT became equal to a dollar because a bunch of these people accepted it. So you had a very reliable on and off ramp. And that is a trading over like a 1-2 year period that everyone started accepting this USDT as actually being worth a dollar, which is quite crazy how the pandemic kind of advanced those stablecoins. And today, like my grandma, she doesn't touch paper dollars again, right? Like she only uses crypto because she's not worried about getting counterfeit money, right? That's a problem when you're buying paper money. She doesn't have to, she's 87, right? Like she's fragile, I don't know. She's an elderly person. She doesn't want to be exposed to going to a place where money is being moved, right? Like those places tend not to be that safe. She is a very easy target for someone to rob her when she gets out of the cueva. So she doesn't want to expose herself to that. And then lastly is she can go into a website and compare which crypto platform gives her the best exchange rate. So essentially the spreads are compressing so much that crypto gets better pricing than the cuevas. So what you created is you had a Macy's or you had a mom and pop shops selling you assets, and suddenly you created Amazon. And it's like the prices are better. You do it from your home, right? You know what you're getting. You can return it. Like it became so much better that it's like, why would you go back, right, to buying from a traditional retailer and not Amazon? So stablecoins in Argentina became kind of like the Amazon of the US dollar, right? And I think adoption is going to continue to grow. It's in the adoption curve. I think it's like still not halfway there, but like it's just a matter of time for everything to be in stablecoins.
Super interesting. Yeah, super interesting to hear that your grandma has to be a CFO and she's able to transact with crypto. Curious, are Argentines adopting stablecoins at a faster pace than like sort of crypto native assets like Bitcoin and Ethereum? I'm curious if people are storing their wealth in those assets as well, or if it's mostly stablecoins. And then I'd love it if you could talk through sort of what this is. You know, you mentioned people have to go and convert currency. Everyone's a CFO. I think sometimes people are, showing up on a moped and with a backpack of cash to do these exchanges. What does that look like when it's crypto? So if you're local and you're getting paid in pesos and you're trying to go from there to USDT, USDC, something, we'd love if you could just like kind of talk through like that process as well.
Yeah. So a couple of the exchanges that are in Argentina tell me stablecoins is the entry drug, right? That's how you get started. Yeah. Some of them focus more on DeFi crypto native assets than others. I would say kind of if you are earning $300 a month, which is kind of a little bit higher than the minimum salary in Argentina, but kind of close to that, you stay on your dollars, right? Like investing in Bitcoin and having a 30-day kind of drawdown in a day is not palatable if that is a meaningful part of your wealth, and if you don't have a lot, like if you're very close to needing that money, right? Kind of like middle class or middle upper class, those people will explore a little bit more. Bitcoin and Ethereum are, of course, the biggest assets, and they will start storing some of their wealth there. I would say the ownership of these types of assets versus what you would expect in the US is a lot less, right? In the US, the story is about Bitcoin, Ethereum, maybe Solana and altcoins, and not much about stablecoins. I would say it's the opposite in Argentina. I would say it's 80-20, but the other way around. That 20 still is very good, right? Like, because you get that 20 represents a lot of people that access that. And of the addressable market of like people that have enough means to kind of invest in these assets, a number of them are exploring it. Most of these exchanges are trying to push that more and more, right? Like the founders starting these exchanges are very crypto native people. They'll give you a credit card and the cashback will be in Bitcoin, for example, so you can get your first sats. So they're exploring ways in which they can kind of convert you from a stablecoin buyer, which is the kind of the starting point, to a more a crypto native holder. For several reasons. Obviously, stablecoins is a very competitive market, hard to make margins. The other one is a lot better, but then also from a philosophical perspective. In the second question regarding the UX, so the UX that my grandma uses, for example, is she gets her retirement money deposited in her bank account, call it the first 5 days of the month. She will transfer that into the exchange. That it takes about a second, right? So Argentina's payment system has finality within a second. So that is, in theory, that's what the US should accomplish once FedNow is fully integrated into the banks, and banks can sell between each other kind of like on a second latency, and all banks adopted it. That's the equivalent of what you have in Argentina. So she can transfer money into an exchange kind of immediately. And then on the exchange, you just press a swap, right? So it is similar to the experience that you get when you deposit via ACH on Coinbase, except with it's final, so you can withdraw those assets immediately. Whereas Coinbase, they are taking the Forex risk in the middle because you can reverse that ACH. Now, that experience is, I would say that's the experience most people do. Most people still buy from Cuevas. The reason for that is if you are a freelancer, if you are a business, and you pay all of the taxes you're supposed to be paying, there's no way you can make money, right? A freelancer, let's say last year, when the difference between the blue rate and the real rate was 50%, if you bring your money through the official path, your initial tax is at 50% from the delta between the two exchange rates, plus then you have to pay your taxes. So your total tax rate will be like 75%. Most people don't want to expose themselves to that. So it's so outrageous that people just avoid it. Yeah. And in that case, you would do a paper transaction, which is the moped that you were mentioning. And in those cases, right, like you have to pay your rent in cash. You have to pay, there's a bunch of people that live with cash. And you tell your trusted Cuevero, hey, I'm going to sell you 8,000 USDT. They will come to your home with literally a bag of cash. Right? Like imagine like a delivery bag of cash, like with one of those things is like $100, right? So you're probably getting 10 of those, right? It's like total. And you just exchange that. Usually you don't count it. You just trust the guy and then just probably count the blocks. You don't wait it. At least I haven't seen anyone wait their money, but that would be pretty cool. And that's how still a bunch of the transactions happen, right? And I would say most of the transactions still happen that way because you're able to use cash as a way to free yourself from that outrageous tax rate. I'm going to say I'm a big supporter of Milei. Milei acknowledges the fact that the tax rates are insane and is starting the process of cutting those tax rates. So I think that will change substantially in the in Argentina with a simplified kind of tax model. So I hope we move into the first UX that my grandma uses and less of the cash model, so more people can move into being on the right with the government.
Yeah, that makes a lot of sense. And so if we go back to like the crypto version here, so you kind of do that exchange through an exchange. And then what does that look like once you've got some stables, converted, you're storing some of your wealth in something that's backed by US dollars? Are people able to transact with that? Is that really almost like your savings account? And then you're paying with pesos, maybe with hard cash in person or with a credit card, something like that. Is that sort of the setup right now? And maybe merchants are starting to sort of come on board?
Yeah, so I would say it's usually a savings account. And the custody is usually not self-custody. It's done by the exchanges. So the exchanges are custodial in nature. And then usually it's a saving account. And some people will, like my mom, she will buy dollars with everything. And then she will use the card. And every time you swipe the card, the exchange auto-converts like the USD, in her case USDM, but whatever stablecoin you have into the pesos for that specific transaction. So she will do just-in-time transactions so as not to hold that peso. So that is usually the experience. Either you save half of your salary and spend the pesos with the rest, or you buy all of your salary and use the card to swipe. In general, buying with merchants with stablecoins is still not that common at the low end, right? So if you're buying something that's less than, say, $200, It is not that easy. If you're buying anything that's higher than that, it's very normal that the prices will be in dollars, and many of those will take stablecoins. If you think about an apartment, many apartments have been purchased with USDT already. Cars, same thing. Lots of cars have been purchased with stablecoins. Machinery, anything that has to do with business, imports and exports, a lot of those have been done with crypto, and it's quite normal. We know a story of football players, right? So a club sold a football player, and they received payment in crypto. So you have a lot of crypto transactions in stablecoins at the higher end of the ticket value.
Martin, you mentioned your grandma now uses USDM, which is great because then they can get additional yield on top of that. We'll speak about the details a bit later on. But I think one topic that's got a lot of attention from the research side of the crypto space is the geographical split between which stablecoins are adopted in which parts of the world. And I mentioned in the intro there that you have USDC and USDT, whereas USDC seems to be more of a US-based asset that's used in DeFi, whereas USDT is actually more prevalent on Ethereum and especially the Tron blockchain in developing markets. Mm-hmm. So I wanted to hear your thoughts, and maybe if you could shed a little bit of light on whether you've seen more USDT or Tron adoption in Argentina and why that really is, because I think that's missing from the discussion of where these geographical differences come from. It's like, why is USDT more adopted in the developing countries?
Yeah, so I would say, I think your split is 80% accurate. The way I think about it, my mental model is USDC is developed countries, USDT is emerging economies. And emerging economies being also the house of most exchanges, right? Like most of the exchanges, I would say outside of Coinbase and Kraken are probably like Asian exchanges, in like your Binance, your OKX, your Bybit, all of those are developing country exchanges. So USDT was clearly the first one. Being the first gives you various advantages. A, you're integrated by default. No one does a risk assessment before they integrate USDT on their exchange, on their protocol. It's like you kind of have to, right? If that risk assessment gives you a AAA or it gives you a C, you're still integrating USDT because you have to, because that's where the liquidity is. So they have a big advantage there. And by being the first, they have had a lot of time to educate people that a USDT is equal to a USD. And they've built a lot of trust and education at the retail level. The other advantage that USDT has is it has the granularity for on and off ramps, right? Any ramp that you take away Coinbase, imagine you couldn't transact in Coinbase. What is the easiest way to get stablecoins? Regardless of where you're going to go, you're going to have to pay a spread. And the most likely thing is USDT is going to have a lower spread than USDC because, of course, the prices change, but both of them are implementing fees to get out. USDT also has fees to get in, but it has so much liquidity that usually the spreads are going to be thinner. So USDT gives you more granularity, more ramps, and more acceptance. And therefore, it's what people are used to using, right? Money tends to aggregate to a top winner, and it is hard to switch. And why would you, right? So if you are using USDT has always been worth $1. The users of USDT have never had a chance where they were trying to sell USDT and it was not $1. So then what is the use case to change to USDC? In the US is, okay, you get free on-ramps with Coinbase, but if Coinbase will not open an account if you're Argentinian, so then why would you switch? And that's why USDT keeps winning. If I were to give some feedback to Circle, I would say hop on a plane and visit emerging economies and see how you can get better at solving the problems of these folks. Whereas USDC has been very much focused on DeFi, right? And that's why they've won a lot more of the DeFi battle. The issue with DeFi is it's a lot more mercenary, right? Like people are in DeFi because they're, like I would say, not as a bad thing, but like speculating, right? Like most of the activity in DeFi is concentrated around price appreciation of base assets. And if base assets don't appreciate in value, DeFi kind of mostly dies, right? So if Bitcoin, ETH, Solana, etc., were to be flat for the next 10 years, how much of DeFi could actually sustain? Probably not that much. So, and USDC has won that, so it's bound to the circles of that market, whereas USDT is bound to the adoption of euro dollars on blockchains in the emerging markets. So I think that's the big difference. And USDT has been growing on that trend because if you look at their graph, it's just up and to the right because the adoption of euro dollars in emerging markets continues to chug along, and most, if not all of that, is USDT. So yeah, and I think USDT, like if you hear Paolo speaking and acting, he goes to Argentina, he goes to like the central meat market of Argentina, not the classy developers in Palermo. He goes to like where the transactions are happening. He goes to the central market in Turkey and like talks to the guys there and is like, how can we help you, right? What do you need? And I think they've been very successful because they're very close to that user, and they're not nervous about serving that user, which in the end is the user that really, really, really needs the product, and kind of like the user I empathize the most with.
That's super interesting context, because when you think of it from a go-to-market perspective, it is much quicker when you're solving an immediate problem that people have today, and you can onboard them right away. Whereas maybe from a strategic perspective, USDC is trying to kind of educate people on what the problem might be and bring more institutional capital on chain and stuff like that. So very two different go-to-market approaches.
Can I share a kind of contrary view?
Please do.
Lots of people think institutional capital is coming like crazy to crypto. I am a little bit less of that view, right? So I think there's institutional capital coming to crypto to buy non-TradFi assets, right? So the ETFs are very good because you give access to TradFi. It's something that they didn't have access before. I would say stablecoins are not that, right? If you go to any large institution, they're kind of pretty well served by the existing system, right? Especially if you go to Wall Street, right? Like the whole financial system is wired around the epicenter, which is Wall Street. So they don't have that many problems with the existing financial system. So I think when we say institutions in crypto, we mean medium to kind of like low size enterprises that transact cross-border with crypto. And I think stablecoins are servicing that pain. But I still think we have to do a lot more work before we bring BlackRock in as a customer rather than as a vendor into the space. And I think the biggest barrier to that before we can do that is we need to have clarity on the largest financial market in the world. We need to have regulatory clarity in the US, right? No one is going to come in and play and then take a 1% chance of getting a Wells notice for whatever they're doing, right?
Curious your thoughts on Milei, and sort of if you've got sort of an eye on what's happening, I guess, with regulation and things since he's come in as the new president over in Argentina.
I've never been a big in politics, but now I am. So I'm a big Milei fan. They call him the Leon. So I'm with the Lion. This is the first time I see a government where I hear people speak and I'm like, that is exactly what I think. So if you hear Milei, he never gives speeches in English, which I think is a mistake because the rest of the world cannot hear what he's saying. But now with the translators, I urge you to go watch some of those speeches. He gave a speech on the biggest e-commerce platform in Argentina, now kind of like in Latam. It's called Mercado Libre. They recently broke 100 billion in market cap. They listed in the US. And he was saying, the government doesn't generate wealth. That is not our job. Our job is to make sure that we create a clear rule game and get out as much of the way as we can. And one of the main things they did is they created this Ministry of Deregulation, which is similar to what Elon and Trump are talking about in the US, I think inspired on what happened there. And the Ministry of Deregulation was the head of the central bank on the previous kind of like non-populist government in Argentina, Sturzenegger. And what he did is he reviewed all of the rules of Argentina, all of the laws. We have 4,800 laws since the beginning of time. And then he crowdsourced some experts, people that are also kind of like pro-markets and kind of like smaller government. He was like, what do we need to adjust on this law? And there's like a ton of them. And they reviewed every law and they were like, we're going to adopt a change, like completely clean slate everything and make sure things start to make sense. And of course you have to prioritize and so on, but they've already passed amended 800 laws, right? So they're like, call it 20% of the way into making that happen. Milei also, he did some of the things that are like very non-mid-curve. If you spend less money, inflation will go down because you don't need to print, and therefore you're going to be able to run the economy without like choking that economy. It worked. Inflation was trending upwards, insane. Now it's down to about 4% monthly when it was like 20% monthly, still and going down very fast. So it's kind of quite a miracle to see that. You see a government surplus in 1 month. And with that government surplus, he prepaid interest on the debt to make sure we don't default, so that the risk, the country risk of Argentina goes down, so that businesses can finance at a cheaper rate. So a lot of the things that are happening that are, like you would say, this is an opinion that is based or like a common sense thing, doing a bunch of those, but with like high government capacity, right? Like the capacity to get things through. I am very bullish. His view is that, which is something I can connect with, is Ezeiza, which is the biggest airport in Buenos Aires, the international airport, is going to turn from a place where our young people go to say goodbye to Argentina to a place where foreigners are going to land and say, I'm in my new home. And if we keep this way, his views, in 40 years, we could be a top, one of the top kind of countries in that G20. And I think it's very, very possible. Of course, you have to push against a lot of entrenched interests, and making those fights are not easy. And it is not, obviously a one battle, but the substance is there. And I think the government has the right view of getting out of the way. So I would suggest, I'll send some links to podcasts afterwards where they interview some of these people. They're all in Spanish, but you can enter it into one of the translation services. I think it's good to hear and say, this is a government I can get behind with. And again, first time in my life, I have that thing.
Very cool. Yeah, no, please share those links. Yeah, it sounds like it's like almost like somebody coming in and running a country like you would run a business, and, starting a company, and just love it. Very refreshing.
In founder mode, yeah.
Yeah, very cool. So maybe this is a good place to sort of transition a little bit here. I think the elephant in the room as it pertains to the sort of larger stablecoins out there, USDT, USDC, I think about $160 billion market cap today, not paying a yield on this, right? So these are companies that are essentially taking in dollar deposits. They're going out and buying, assets that are earning a yield. They're capturing all that yield, and they're not sharing any with the depositor, with stablecoin holder. I'm curious if this is the reason you started Mountain, that you looked at this and you said, okay, your yield is like my opportunity, essentially, or your margin's my opportunity.
Exactly.
Get your views on that, and like, where do you see the market going here? Is this seems unsustainable, but curious your views on that.
Yeah. So the origin story is exactly like you said. So I worked previous to the pandemic, many banks in the US launched high yield checking accounts. Those were a big success. Marcos probably kind of the marquee case, but many other banks issued this in a kind of like to acquire deposits. And obviously, why would you stay in a FDIC insured account at 0% when you can go to an FDIC insured account that pays you SOFR? At that time, it was like 2%, now 5%. It's a risk equivalent decision where the difference is how much margin your counterparty is getting. On stablecoins, it was the same thing, right? So why would you stay with USDC or USDT paying you 0 when you can go to USDM and get today 5%? When the underlying assets are exactly the same. They're both quite essentially US government obligations that are short term. It's a risk equivalent decision, and it's kind of like your margin is my opportunity. But just to give a size to this, outside of probably Binance and Coinbase, Tether and Circle are the two most profitable businesses in crypto. And the big reason why people are not moving like crazy out of it is because they're not paying the cost out of their own pocket. They are kind of like not receiving revenue that they should have gotten. Yeah. And the order of magnitude is the order of magnitude of an ETF, right? So the ETFs on BTC have kind of like plateaued now. Those inflows are in the order of magnitude of what Tether and Circle make. So imagine keeping all that value inside of the system. How much more could the system grow if that value was kept in? I think the number would be substantial. With flows, it's very hard to see because you change the flows 10% and things move a lot, right? Obviously, Circle and Tether are both making more money than Ethereum. So the numbers are quite crazy.
Really?
In our view, the biggest issue is not what I just said, is that crypto will never actually grow if you don't have yield-bearing stablecoins, right? So I'm of the view that rates are not going back to 0. If rates are going back to zero, I think the discussion changes. But in a world where inflation in the US is no longer a proxy zero and people are asking for a return on their bonds, which I think is the reality that we're seeing in the market, the rates are going to be, who knows, but they're going to be non-zero. They might stay at 5% or 4 or something like that. They might go down to 2. All of these numbers are non-zero for economics purposes. We are asking for institutions to come into crypto and for the real economy to start moving on crypto, not just 160 billion, which is about like 0.1% of the dollar, the kind of the USM2 in circulation. We want to get to $10 trillion, right? Which is 10% of the M2 in the world, or duplicating the euro-dollar market. If you want that market to come in, you have to provide that market with a way better product than they're getting today. And today, all of these institutions are getting yield on their assets. And yeah, there might be some cash work here and there, but I would say like 95% of their deposits are getting the risk-free rate. So if we are building our ecosystem around you're getting nothing if you're in stable coins, and if you want to get yield, you have to rehypothecate and take not only the stablecoin risk, but take the smart contract risk of whatever lending market you're using, and you're subject to the fluctuations of that market. The institutions are not going to come in, and we can see it with some of our early customers, right? So we have a partner called Names. They are a reinsurance company out of Bermuda. They sell essentially capital against risk that insurance companies want to place in the platform. So let's say you're a company, you're insuring hurricanes in Florida. This is a true example. You'll put a portion of that capacity into the Names platform, and the Names platform allows investors to put money and essentially get the premiums from that. If you're doing it outside of crypto, you're putting that money in essentially kind of like a money market fund or something like that, right? And the collateral, in case there's a hurricane, is sitting there and it's earning, call it 5% until it's returned to you or until it's used. In the case of crypto, without USDM, that would be earning 0. So let's say the premiums, in this case, they're like about 7%. You're getting 7% plus 0 from USDC, a total 7 for insuring hurricane risk in Florida. So you're getting 200 bips over SOFR. No investor is going to do that. Now, if you change it and you say you're getting 7 plus 5, which is the equivalent of TradFi, 12%, that starts to make sense because I'm getting 700 bips on top of SOFR for taking this risk. And it's something that I cannot buy in the traditional market because I'm a smaller family office. Okay, it starts to make a lot of sense. A lot of these flows, if we're going to ask these institutions to start moving these flows on chain, we have to be able to give them a kind of like the equivalent of what they are used to in terms of like cash management. And that is why kind of like I think the big market for USDM is very risk averse, but smart investors. And we hope we can also get into the retail, right? Because retail in general, not that sophisticated, but hopefully if you have $100 and we give you an additional $5, that $5, if you only have 100, is a lot of money. So we hope retail can also transition. But overall, I think the big opportunity for Mountain is enable crypto for large institutions to start driving capital in.
One thing that I guess me and Mike have been speaking about a little bit is just the fact that banks will want to issue stablecoins, given everything that you kind of just laid out there and looking at how good of a business this is. Do you agree with that take? And if yes, do you think that those stablecoins will be seen as money or investments?
So, I think banks will want to issue this 100%. The constraint, like if you look at the banking system today, most banks are deposit-taking institutions that lend to AAA corporates. That's the average bank. The thought of like banks issuing loans to small and medium businesses and so on is more the exception than the rule. And this kind of AAA corporates can take a lot of money at like SOFR plus 150 bips, right? So there is no limit to how much debt you can issue as a bank to very low risk institutions. So the bottleneck for banks kind of like balance sheet size and therefore profits is on deposits. And the stablecoin, like imagine the stablecoin bill passes in the US, you're suddenly giving the banks the biggest addressable market unlock for stablecoins probably in the history of humanity, right? So let's walk through the numbers. And the US government has, the US has about $10 trillion M2, right? That's how much money is in the US economy. And then the euro dollar market is another 10 trillion. So call it, there's a total roughly 20 trillion of US dollars, 10 in the US, 10 outside the US. And then you have the rest of the money supply of the world, which totals to about 140. So about 120 is non-US dollar and 20 is US dollars. Or said the other way is $130 trillion sit outside the US and 10 sit inside the US. Out of this 130, 10 have been captured by the euro dollar market and 120 have not, right? So the penetration of that market is roughly 10%, a little bit less than 10%, with a model that makes distribution very hard because you have to be compliant in each country that you're driving a euro dollar market, with economics that don't make sense, right? If you want to bank someone that is going to deposit $100, it doesn't make any sense, right? If you're trying to open a bank account, I think in Europe it's been a little bit easier with Wise and so on. But imagine 10 years back, it was very hard to secure a dollar bank account in Europe. Now imagine Argentina, right? So almost impossible. All of Asia, very, very hard. The local governments don't want you to bank in dollars. So you have like a very complex way to secure dollars in the rest of the world, and you still have 10 trillion. Now you put stable coins in, and you're saying you're buying an asset that is equivalent to having a deposit on Bank of America in the US. And your government doesn't have to allow you to have it. You can just buy it on a blockchain. What's the size of that market? Like, I don't know, 10 trillion? Like, it is that order of magnitude. So I think banks are going to rush to create these stable coins. I think on-ramps, which is a problem that we have today, is going to stop being a problem because suddenly any ATM becomes an on and off ramp. And banks, you should be able to get in and out via ACH or wire. So on and off ramps should become a non-issue. And I think the tension that we're going to have in crypto then is going to be the recipients of those dollars that are no longer using alternative M2s suddenly pushing back, right? So what we see with Binance in Nigeria now, where Nigeria is trying to push back from dollars getting into the country, I think we're going to see that intensify a lot. So I think overall, I'm very bullish on stablecoins and the impact that they have to the kind of the dollar as a whole, particularly the bond market. And the other thing is like freedom for Argentinians, right? If I want to buy a dollar, my grandma wants to buy a dollar, we should be able to do it. And hopefully we can do it in a way that's regulated versus what we have today, which is kind of very outside of the system and very pressured. So I think banks will definitely do it. It is you can essentially double the size of the deposit balance that they can get with this product. So I don't see any world in which there's no 10, 20 big players kind of going after this market. Banks are slow. So when we say banks running, it means 1 year after the stablecoin bill passes. It's not going to be the day after. But I think it's going to be very big. For my former employer, McKinsey, like the amount of consulting projects that are going to be sold on launching stablecoins are going to be insane. The project management offices, like all of that business is going to move a lot. And the question is going to be, what are the assets that we're going to see coming out of the other side? I think one asset to speculate here, you have BOFA USD, right? So Bank of America issuing their dollar on chain. I think if I have to speculate, that will be a non-yield bearing stablecoin, just because BOFA is used to non-yield bearing assets and people banking with them without paying any yield. And I don't think they're going to change that for the stablecoin market. But they're going to have a very big thing, which is the kind of like the widest ATM and like physical footprint, and videos on TikTok of someone going in, depositing their BOFA card, depositing with a QR code 10 BOFA USD and taking a $10 bill. And it's going to be like, okay, this is a dollar. It's Bank of America. I know it. Perfect. So I think we're going to see a bunch of those. Probably the Bank of America's, like the G-SIBs are going to go in that direction. But then I think we're going to see the same rush that we had with the high yield checking accounts kind of prior to COVID and kind of that we have now, which the kind of not the top 6, but the next 20 banks issuing kind of yield bearing stablecoins. So imagine Marcus USD from Goldman Sachs paying you 5%, and you can essentially have the Marcus brand and it's held in the Goldman Sachs balance sheet. I think it's going to be a very, very, very successful product. And if you think about that world, I don't know, I see a lot of podcasts now like, oh, crypto is over. I don't know what we're building. Imagine that world, $10 trillion in stable coins, what that does to cross-border commerce, savings in emerging markets, what that does to like, now that people have dollars, what they can do with those on chain. So I don't know. I don't know if you can see I'm super bullish on the space as stablecoins as the enabler, and that regulation will be the key thing that will unlock a lot of that.
Yeah, we can see that. And reading between the lines there, you believe that these bank-issued stablecoins will be launched on public blockchains, correct? So that they maintain fungibility with everything else in the crypto ecosystem.
And you talked a little bit about regulation, right? What's going to happen? And I answered will banks launch stablecoins? I didn't answer the regulation question. So I think in regulation, you're seeing kind of countries fall into one of three buckets. Bucket number one is we are not comfortable with this. We saw FTX. We saw kind of like all the shenanigans that happened. We're going to crack down. And we saw Elizabeth Warren talking that Hamas is funding themselves on blockchains and all of these things. I don't think they're true, but whatever. Crack down. And I think the US falls into this bucket. Nigeria falls into this bucket. Argentina historically has fallen into this bucket, although for a different reason. In that case, it was like compliance in the front, but actually monetary sovereignty in the back. So you have that first bucket where most countries in the world still are today. The second bucket is, okay, stablecoins are inevitable. We need to do something about stablecoins, but we're going to try to make sure that stablecoins are not too disruptive. And in that bucket, you have countries saying, okay, you'll have to have stablecoins, but the deposits have to be in the banking system, taking banking risk. They cannot be in US treasuries because if not, we take too many deposits from the banks. And they are not able to pay yield because we think it's risky because of, I don't know, maybe because of Luna. Mike, I think, is an example of that regulation where the product is worse for users so that it's better for banks. I don't think they're going to be very successful, but you have some jurisdictions falling into that bucket. And the third bucket is kind of like the first principle stablecoin regulators. And here, I think the two notable actors are Bermuda, which is where we're regulated, and also Abu Dhabi, where some other companies are regulated. And what these guys are saying is, we want to create a safe stablecoin that is safe in various ways. On the compliance, I think in that anyone that has regulated stablecoins has agreed that we can do it in a safe way. In my opinion, a better way than traditional finance, but also safe for the user, right? So it has to be what we all know, right? Like very short-term treasuries, bankruptcy remote, backed one-to-one, no weird assets in the balance sheet and so on. But they didn't force you to use specific banks or national banks or so on. You can use the best-in-class bank that you can get. They don't stop you from paying yield because they understand. And actually, ADGM, which is Abu Dhabi's authority, actually said this in their consultation letter. If we want this to be used as a means of payment, it also has to be a good store of value, right? So you have to have yield if you want institutions to come in and store their value here. I think that hopefully is the winning camp. And the reason I think that is more likely than not is the US government kind of needs this M2 dollar explosion that stablecoins can provide. And if you can provide a better product, which essentially safe assets, yield-bearing assets, all of those things check the box, I think it's more likely that stablecoins are going to be successful. And the way the US government benefits is more buyers of T-bills, essentially, more buyers of US debt. So I hope the US goes from bucket 1 to bucket 3 directly. And I think that's at least when I think about this, the most likely scenario for this to play out. Hope it happens.
The incentives seem to be in place for this. It seems like we should be very bullish on proliferating as many coins out there as possible.
There is a wild card, right? So the lobbying that banks can do is very strong, and particularly the larger banks. Top 4 banks in the US account for 60% of the deposits, but they account, I don't recall the number right now, but 90% of the profits, right? So if you think about the profits in the bank in Main Street, all of those profits are with Bank of America, Citi, Wells Fargo, like the G-SIBs. They have a lot of lobbying power, and for them, they can get away with a non-yield-bearing stablecoin, right? So if you can say, I'll be iPhone and only serve 10% of the market, but I'll make 100% of the profit. Or you could say that regulation will allow for Android, we can solve the whole market, but the profits are going to be smaller. The banks are incentivized for the iPhone is the only legal thing. The US government is incentivized to let's allow the Android to be legal as well. So it is not obvious that will happen because of lobbying. And not only the big banks, there's other interested parties, particularly people that are making a lot of money today on stablecoins. But that is the wild card on why we might end on bucket 2 and not bucket 3.
Yeah, it's going to be really fascinating to follow how this all shapes out. And I do think you're right. Like the regulators probably are going to play a role in some of the winners and losers here for sure.
Definitely.
As we see this future of everybody beginning to capitalize on this massive market opportunity of stablecoins, do you see the liquidity moats of the current market leaders, USDC and USDT, deteriorating over time then?
I think they will have a space. I think particularly USDT, they know that yield-bearing stablecoins are coming, and their view is we want to be at the edges, providing a service that is very hard to provide otherwise, which is kind of on and off ramps or last mile, stuff like that. Tangibly, for example, Tether is working on integration with Pix, which is the retail payment network of Brazil, so that participants can go from reais, which is the Brazilian fiat currency, to USDT in a very seamless way. The only way that you can do this investment is if your margins are very, very big, right? So, and Tether is doing these investments in various different jurisdictions. So I think there's a space still in the kind of emerging market, low ticket size, but your margin is pretty good for Tether to continue playing. I think for Circle, if we end up in bucket 3, I think it's going to be a little bit more challenging because suddenly on and off ramps are no longer a competitive dynamic or a competitive advantage. So your partnership with Coinbase becomes a lot less valuable because you can just buy stablecoins on your online banking. And I think that is going to be a harder one to keep. I would never discount Circle. I think they're smart. They're going to find a way to play. But definitely the moat, I think, for USDT is a lot stronger than it is for USDC. But yeah, and then when you think about yield-bearing stablecoins, in the end, as a stablecoin, you are going to be a means of transporting value, right? So I don't think there's going to be 20 successful yield-bearing stablecoins. There's going to be a handful, just like we've seen with the traditional non-yield-bearing stablecoin market. So you have USDT, USDC, DAI, and everyone else, right? So it's a 80%, 60% of the market is USDT, 20% is USDC, 10% or 5% is DAI, and then everyone else is 5%. I think we're going to see a similar dynamic with yield-bearing stablecoins. And the question is who can get in and build that liquidity kind of early on so that the users can do whatever they need to do without having to worry about, is this integrated? Who am I going to place this stablecoin with afterwards and so on? So I hope we have a little bit of an advantage in building that. But yeah, I think it's going to be a couple players who are going to be winning that race.
Interesting. And is your thinking there kind of related to are you expecting things to sort of start to get built on top of some of these things? We're gonna get into Mountain in a second here, but is your view that just there's sort of a network effect? You got the liquidity network effect, then you also get sort of integrations, and you just think that will sort of drive network effects?
Yeah, so I think anything that is economically driven, where the convenience factor is a little bit less than the only thing that matters, yield-bearing stablecoins should start to replace traditional stablecoins. So that would be, for example, liquidity on AMMs or trading pairs. I think trading pairs on centralized exchanges is a little bit harder, but liquidity on AMMs, we're already starting to see some players choose a yield-bearing stablecoin like Mountain instead of choosing USDC or USDT, because they save money on incentivizing those pools, those LPs. And if the weights of economics start to matter more, right? Like the more bear market you are, the more people have to sharpen the pencil, the more these things matter, right? So we're starting to see some of those happen. You see yield-bearing stablecoins should be if you look at the balance sheet of Hyperliquid, for example, I think they have $400 million of USDC. Multiply that by 5%.
Yeah.
And then tell me, why does Hyperliquid apply for a grant? Like, no grant size is going to be bigger than the 5% you can get on those $400 million, right? So all of that should be built on yield-bearing stablecoins, just like the equivalent product on TradFi is built on earning that yield on very short-term US treasuries. So the insurance use case we talked about. So there's a ton of these use cases. One that is a little bit more nuanced, that is interesting to talk about, like in DeFi, and I imagine the audience will enjoy this, is when you're thinking about Aave, for example, or Compound. when you're depositing like the use case for most of this is you deposit stablecoins to earn yield, or you borrow stablecoins to lever up on some kind of asset. Yeah. So when you deposit $100 of USDT on Aave today, and let's say the utilization is 80%, which is their average kind of long-term utilization, there's still 20% of USDT that is sitting there earning zero, right? So 80% got lent out, and it's an IOU earning whatever the lender is paying, the borrower is paying, and then 20% is earning zero. So the lender is earning 80% times whatever the borrower is paying, plus 20% times zero. So in TradFi, that is equivalent to 5%, call it 100 pips of difference. 100 pips in TradFi is a lot. If you go to any kind of corporate debt portfolio, the difference in 100 pips is the difference from a company that you know is very solid to a company that you start having questions, right? Yeah. So I hope that one starts turning into yield-bearing stablecoins as well. I would say in general, it's very hard to argue outside of Mika banned yield-bearing stablecoins why you would not hold a yield-bearing stablecoin.
Yeah. I see the use case for it, even just for the DeFi report. So maybe this is a good sort of place to transition into Mountain and just learn a little bit. I'd love maybe if you could just share a little bit about kind of the launch story here, like when you decided this was the sort of part of the market that you were going to go after, and just take us back to that kind of founding story a little bit.
Awesome. So I shared a little bit about my background. So coming from banking, I know how to build balance sheets and how banks work. I think stablecoins, if you ask my grandma what she thinks she has, she looks at it as a bank deposit. So if we believe stablecoin matches end user expectation, stablecoins will end up being regulated like banks. And I think we're just in that discovery process until we get to that point. Yeah. So when I looked at stablecoins in 2020, I was like, this is like a tokenized bank deposit. And when rates started going up, I was like, how am I getting yield on my markets account that is higher than what I'm getting on USDC on Aave, for example? And the difference was like 2% versus 0.5% on Aave. And then I was like, we have to go after this opportunity. There has to be a yield-bearing stablecoin, and the experience has to be a stablecoin experience because the product is a stablecoin. And after that, there was like an 18-month period of finding a good jurisdiction that saw eye to eye with what we see as the market, and actually getting licensed by that jurisdiction. And I talked to a ton of regulators in 2022. I feel like now I'm a little bit less of an expert on regulation, but in 2022, I knew like where each regulator's head was at. And Bermuda can strike me as a great place to be because they know how to build very safe and predictable products, right? A third of the global reinsurance industry is based out of Bermuda because the regulator is sophisticated and the courts are predictable. So you have some of the largest finance players in the world deciding to locate there, and some people say, oh, it's just taxes. The low taxes you can get in many places. The reason capital concentrates there is not taxes. Of course, taxes help, but the quality of the laws, the fact that you can talk to a regulator and adjust guidance, and then the predictability of the courts. If something goes wrong, you know that the courts will opine with what the spirit of the law was. And if you think about stablecoins, you need the same type of security. You need a regulation that adapts to what you're building, and you need the comfort, and particularly for large stablecoin buyers, like most people don't think about what happens if USDC defaults and you have to go to a court order. I had several, right? So I had to file claims for Mt. Gox. I have some in FTX. I was on ramping. I have several processes where I was there. And I've also worked with receiverships in banks, so I know how messy this process is. Yep. In Bermuda, they made sure when they built the regulation that they took the worst case scenario of liquidation into account. And the guidance establishes what happens if Mountain were to lose their license, if we were to lose our money. So Bermuda, I think, still is the number one place to go and create a stable coin. I think the only one who can actually take that spot from Bermuda is the US, just because they are the issuers of the US dollar. But outside of that, they are very sophisticated. So we found the opportunity, 18 months to actually find the right jurisdiction and get licensed there. And we launched in Q4 of last year. So we're close to the year mark now. And it's been a work of getting USDM into the hands of as many users as we can. And that means creating liquidity pools, creating being on multiple chains where people have to trade and so on. So that's been an effort. For projects that have a token, I feel like that's a lot easier. When you're doing a regulated financial product, I don't think many of these projects are going to have tokens, because the regulator is looking at that project and it's like, who's the UBO, the ultimate beneficiary owner of this? Very, very hard. And I still don't have an answer of if you're finding how you can have a token. So that is hard to build. And then distributing and finding buyers for these products. Fortunately, and kind of like where we've focused ourselves during kind of like the first portion is on sophisticated buyers that understand the risk of going into riskier propositions, but that also want to get some yield. And that's been a bunch of like mostly DAOs, treasuries, and so on, where they were sitting on mostly USDC. And they were like, USDC is making all this money. I want something that is equivalent to USDC. I don't want to take marginal risk. I don't want to go into like Aave, DAI, Ethena, etc. I want something that's like very low risk, but I want to get 80% of the yield that these other offerings have. And that's where we've been the most successful on since we started. Where we're moving now is into, okay, now that there is a TVL for USDM, there is some liquidity. In some blockchains, you can sell $10 million of USDM with 2 or 3 bips of slippage. So like very healthy numbers. Yeah. Now we're gearing more into DeFi and integrating USDM into what I call like permission DeFi, where the DAO has to vote yes to something, versus permissionless DeFi like Uniswap, where anyone can create a pool. Yeah. And that is your Compound, your Aave, your GMX, you name it. And also your native bridging, like a bunch of these other features that make the product really, really, really useful for folks. And hopefully, when we have this conversation a year from now, most of the DeFi users should be holding USDM because they're getting a 150, 200 bip delta in USDM versus what they're getting on their traditional USDC or USDT deployments.
Interesting. Yeah, makes sense. So making some integrations into DeFi 18 months before you got launched. So went through that licensing process. I'm sure that was a bit of a challenge. So congratulations on all that. So maybe to talk about this from the user perspective. So like if I'm holding USD, I'm holding essentially a token that is backed by some US treasuries in a bank account somewhere. And when I redeem, there should be reserves against that dollar. Yep.
Yeah, I would say most people think that's the case. There's dollars in a bank account and it's backed by that. In practice, and if you look at some of the assessments on USDC, it's actually an unsecured debt of Circle. So if USDC, that's why when Silicon Valley Bank went down and people thought, okay, Circle might go under, it's not like the reserves are bankruptcy remote, and therefore you get your money back in a week. If Circle goes down, the user will go in the line as long as the employee that didn't get paid their salary, the vendor, like whoever software vendor, Amazon, they all go into the same line. They'll go into court, and a judge has to decide who gets paid first and who gets paid last. And who knows where stablecoins fall, right? Like it's never happened in a US court. So I think that's one of the things that people don't talk about in terms of the liquidation priority of stablecoins as an unsecured instrument. If you look at, in contrast, like Bermuda or Abu Dhabi or even MICA, they make stablecoins bankruptcy remote. So that means the USDM reserve in our case and the USDM, they are separated from the company's assets. So even if there was an impairment at the company, this is isolated and everyone gets 100 cents on the dollar, regardless. Like maybe we won't be able to pay our last vendor, but that doesn't get socialized with the USDM holder, right? The USDM holder goes complete. And I think that was something where people go and see USDC at 82 cents in March 2023. That is the reason why you might want to sell at 82 cents. If this gets liquidated, you don't know what spot you're going to be in. Yeah. But sorry to cut you off, but I think that's a very good nuance to capture.
That's fantastic, because that's kind of where I was going from a user perspective. How should they think about sort of risks? Maybe if you could sort of compare USDC, and I think maybe you just kind of went through it a little bit there, USDC versus going into something like Mountain, where you actually get that yield paid to you. The token itself is backed by treasuries. I believe you're paying that yield on a daily basis. Is that correct? Yeah.
Yeah. So let's start first with like user experience, right? So assuming USDC, you have it in your self-custodial wallet, call it a MetaMask. You open, you see you have 100 USDC in your phone, and you can send it to anyone. The experience with USDM is if you buy 100 USDM today from a curve pool, for example, you're going to have 100 USDM on your wallet, and you're going to be able to send it to anyone. That is a very similar experience. What changes is if you open that same wallet tomorrow, you're going to see a little bit more USDM than you had yesterday. And that is kind of essentially rebasing. So you have more tokens in your wallet, still worth $1, but you might have, instead of 100, you might have 110 cents or 100 and a couple cents. And that means over a year, you might have 105 tokens if rates if the rewards stay at 5%. And you don't have to do anything. You don't have to claim, you don't have to stake, you just have to be using USDM on your wallet. What that means is no matter how simple or complex your flow of funds is, using USDM, the yield is going to accrue to the wallets where the funds have been transitioning, which in the end is kind of like you don't have to think and it just works model. Yeah. Very similar to Lido Stake ETH, and we were very inspired by how they built it. I think the UX is amazing. So that's the first thing. In terms of UX, in terms of risk, the risk of USDM, so you're holding $1, so you have dollar inflation risk. I'm going to not talk about that because if you're holding any stablecoin, the risk is kind of like the same. You're deciding to hold $1. Okay. If you're holding USDM, you have that is backed by US Treasuries, and those US Treasuries have some duration. The standard for stablecoins is that duration is kept very, very short, right? So the average maturity of our portfolio today is like less than 45 days. So that means in 3 or 4 weeks, the whole book circled around. So even if rates go up, the impact on the value of those assets is very, very low, right? It's a couple bips. And if you look at Circle, Paxos, us, etc., we all hold kind of like a couple bips of over collateralization to account for that potential rise in interest rates. And because you hold that over collateralization, if rates want to go up, everyone now is thinking about rates going down. But let's assume we are in 2022 and we don't know if it's going to plateau at 5 or go to 7. Because you have that over collateralization, if rates go up, you don't have to go and run on the bank because you know there's assets to cover you even if there is a run on the bank. Yeah. And because there's that, the run on the bank doesn't happen. Like it's that crazy thing because like no one is going to, if the last person coming to the bank doesn't lose money, that means no one is going to start running, which is a very good thing, and in terms of that over collateralization, very important. Then, so that's the first risk, is in terms of the collateral and the interest rate risk. Then there's the custody risk of like how is that asset custodied, and I think here's where the regulatory regime really matters, right? So if you think about USDM, it's a kind of like a regulated payment stablecoin, and as such, most stablecoin providers are still having to have their reserves kind of like segregated, right? So that would be Mount Protocol, that would be PYUSD with Paxos or USDP, and not the case with, for example, USDC. That's a money transmitter license. And money transmitters, that license can be pretty easy to get, and the oversight is quite low. Like the amount of money transmitters is very, very high, and essentially you have to deposit money in a certain account, but those are still unsecured loans to a certain company. And then you have USDT, which if it goes down, who knows what's going to happen? It's also an unsecured loan to Tether. So I think in that there's a clear difference of what happens if things go wrong. And then the last risk has to do with kind of like, I would say smart contract risk is pretty low, right? Like ERC20s are quite battle tested. If you're holding stable coins, they're all using kind of like the same smart contracts. So I think that's not who knows, maybe there's a 0 day on the ERC20 implementation. If you're in crypto, you're going to feel that pain, but I think the odds of that are very low. What's important about smart contracts is smart contract management, right? So when you're going to mint USDC or USDM, what happens? Who approves that? When you're going to withdraw from the platform, who has to say yes or no? What are the risks of someone getting kidnapped, and how can a kidnapping result on assets being lost? So there's a lot of risk around the smart contract management, or kind of the operational management of the DeFi part or of the crypto side. The TradFi side, because the transactions are slow and reversible, it's very hard to lose money on that side. It's more credit risk, but on the crypto side, it is possible to lose money.
Okay.
And I think there the key things, and when people are doing risk assessments, can the founding team run with the money? And I think if the answer is yes, whether it's by kidnapping or by collusion, have a second look of whether you really want to hold that stablecoin. I think today in the morning there was an issue of someone getting robbed at gunpoint in ETC that I saw on LinkedIn. So these things really happen. And the only way you can solve it is by having third-party signers and unknown signers, which we are required by law to have them, which is, again, kudos to Bermuda for actually thinking about this kind of like edge case scenarios. I think most people don't think about them, and suddenly the Chinese government goes into a bridge and seizes all the funds. And then people are like, oh, we should have done better diligence. The time to do diligence is before you deposit the asset, right? So I think that is not something to be understated, the smart contract operation. And I think they're not applicable to centralized stablecoins, but many decentralized stablecoins. Something that I've seen come in vogue more often now is depositing unbacked stablecoins in protocols. You see that DAI on Morpho, for example. So you pre-mint a bunch, you put them there, and then people can borrow them and leave the collateral. So whenever that purchase happens, the collateral starts being deposited there. My question is, what happens if Morpho breaks? Or what happens if Euler breaks? Or what happens if Aave breaks? These things have been around for 4 years. Bear Stearns was around for 100 years, right? So 4 years is not a very long time in the long scheme of things. So yeah, as you can see, I'm very like worst case scenario driven, but those are the things that you should look at. And we look at USDM as this should be the safest thing that you can have when you have a dollar. And I think Bermuda pushes you a lot to do that because their whole island depends on finance being reliable in the country. And then we also we know there's people holding 10 USDM as their savings, and we're very responsible for those people holding kind of their life savings in USDM. So yeah, I hope that was a good drive through on like different types of risks.
No, yeah, I appreciate you walking through that. And it sounds like the way that Bermuda is doing this is extremely thoughtful in the way they're protecting consumers and, hopefully maybe setting a standard here for how the US actually approaches regulating the space. So I appreciate you walking through that. So I'm based over here in the States, and if I wanted to access, I believe I cannot access USDM, over here in the States, but I believe it's permissionless. And so maybe you could talk, I don't know if you can talk to this, but like, since you guys are already integrated into some of these DeFi protocols, how, you sort of can't really wall this off. It seems like to me there's a permissionless thing, but maybe you could speak a little bit about that.
So the decision to make USDM not available for US participants is more driven around the fact that there's no clarity on how to allow US enterprises to participate. And therefore, Reg S is a good way to protect ourselves from that risk. The way Reg S, the reason for using Reg S, if you say, okay, let's do a worst case scenario. Let's assume we are a security. Let's assume the US passes some regulation, Mountain is not eligible, and therefore we go into the other branch of the tree. That is usually you are a security, right? If you're not a regular financial product like insurance or banking, you're not a commodity, you're probably going to fall into the security bucket.
Sure.
So let's assume that worst case, we fall there. In that case, how do we make sure that we're still okay, given that the SEC has looked back for 5 years and said, 5 years ago, you did this thing, even though there was no clarity. So that's why we use Reg S. What Reg S says is, if your security is offered outside the US, and if, in the case we use Reg S Class 1, if the security doesn't have substantial US market interest, you can offer it permissionlessly, and you're covered by safe harbor rules.
Okay.
And I think that you started with saying selling crypto in the US is very hard. Imagine selling stablecoins in the US. You're like, why wouldn't I use an FDIC insured account? It's less, I'm facing the US government directly. I don't have custody risk. I don't have all of these risks. And why would I use stablecoins if I can pay anyone through Venmo, through wires, and so on? Yeah. So I truly believe the Iowa teacher is not touching USDM. They are also not touching USDC or USDT or any kind of stablecoins. If they're touching anything, they're touching Bitcoin and ETH, right? Yeah. Or maybe Solana or something like that. Yeah. So I would say those assets do have substantial US market interest. I would say stablecoins or dollar assets, or maybe to make it more broad, any real world asset I don't think it's going to have substantial US market interest. So with that exception, yes, Reg S doesn't tell you if $1 is, let's say, a crypto curious person, which we've had a couple, go and buy one USDM to test it out, and they're in the US.
Sure.
We try to monitor that, and if we capture it, we'll reach out to them and say, hey, sell it. But a crypto curious person, or 10 of those or 100 of those, doesn't meet the bar of substantial US market interest. Yeah. You have to really have a product that you're trying to go around the regulation, which in this case, obviously, like we started with this saying, yeah, stablecoins are not very interesting in the US. So I think that is a good answer. But in terms of Reg S, it still raises some issues, right? Like some companies that don't have very strong legal teams don't go with USDM because of this reason, because they're like, yeah, I don't know. So if we could, we would offer it in the US if there was a way to comply. Not because we think the market is huge, but because it makes everything more seamless, right? This is one other thing that people have to think about.
Super interesting. Well, this has been like an absolutely fascinating conversation. I really appreciate you coming in here. And then maybe as we wrap this up a little bit, it would be good to just get your thoughts on, how are you approaching going to market? Are you focused on Argentina and maybe sort of more like crypto native use cases today? And like, do you see when you built Mountain, are you thinking that this is a savings tool? This is more of an investment for people versus, a tool for payments? Or do you see that blending at some point?
Yeah, I see it blending. I think the blending strategy started with high yield checking accounts, right? High yield checking accounts today is a TradFi product that essentially blends checkings and savings, and it makes savings obsolete. And if you look at many banks, savings account usage is going down in usage dramatically, right? So this is not a crypto thing. The merging of those two is happening and more and more. And like if you, even outside of high yield checking accounts, if like brokerage accounts, right? If you go to Robinhood, you're going to get 5% today on your Robinhood cash. So the merging of whatever idle cash you have is in a essentially high yield checking account equivalent is happening across the board in fintech in general. Yeah. And I think in crypto, the very cool thing we can do is because of the power of smart contracts, we can essentially codify that in the smart contract and give users a very legitimate promise or strong statement around what's going to happen with the yield and the rewards that they're getting. And particularly what you can do is you can say everyone is going to get the same. No matter if you are a very large exchange buying 1 billion USDM or you're my grandma buying 5, the smart contract enforces that everyone gets the same. And when thinking about using a product, I think that's a very strong feature that permissionless blockchains and smart contracts can provide that like centralized platforms or even kind of like side deals don't, right? What is the guarantee that this reward program will last if it's done one-to-one via 1-year contract that's non-renewable, right? Sure. I think that's the merging. I think hopefully 10 years from now, people will forget that this distinction happened, like checking and savings. The origin of that has to do with banking happening in paper. You couldn't update that. The moment we went to electronic, that should have died, and it's in the process of dying. It is a slow process. But obviously, if you're doing it on paper, it's going to be very hard to have these things merge. In crypto, as kind of you have centralized database, decentralized database, like that should completely die. In terms of go-to-market, we think the addressable market of USDM is global M2. And I think more and more of that M2 is going to be dollars, just because no matter who you talk to, if they're not holding their local currency, they want to hold dollars, right? So unfortunately, if you see like euro stablecoins, not that popular, right? Because why would I hold a euro stablecoin if I can hold a dollar stablecoin offshore, unless you're in Europe? So I think the dollar stablecoin market can eat more and more of that M2. And I think where that settles is going to be a tension between governments around like how much they allow that to happen. Yeah. Who knows what's going to be the outcome? Inside of that, where we're focusing today is people that are already in crypto. Like we feel selling crypto today as a startup is very hard. People that have not joined crypto yet tend to go with more well-known assets, USDT mostly, maybe USDC if you're an enterprise like Visa and Solana and they use USDC. They're not going to start with USDM. What we are able to do is say, okay, now that you are on stablecoins, here's a risk equivalent stablecoin. You can switch over essentially with one swap, you're essentially protecting yourself against inflation or earning kind of this risk-free yield. And inside of that, we started selling one-to-one, right? Like with people who could, when you're starting off a network and there's no nodes on the network, you have to sell to someone that doesn't need those nodes, right? So that is treasury management is a good use case for that, or savings, or earned products and so on. Now that the network is starting to grow and you have liquidity in AMMs, you have more blockchains, you have soon native bridging and so on, DeFi is kind of like the next thing. I think DeFi is poised to grow a ton. And I think it's a market in itself, but it's also an amazing kind of front end for people to learn about your product, right? Because if you see your product in Aave, it's a very strong signal that, okay, this has passed a risk assessment by whoever the risk assessment advisor is. The DAO voted it to have it. It is a very strong signal. It separates the thousands of tokens that you have from the ones that at least considers are blue chip. So we are focused on kind of DeFi very strongly now, kind of like finishing that phase one, moving to that phase two. And the other place is exchanges, right? So we think exchanges, they're sitting on a ton of stablecoins, mostly USDT. And those stablecoins are mostly earning zero. A lot of their large customers are already asking for something that is yield bearing. And then you're like, okay, now that I have to get a yield bearing dollar, how do I do this, right? And you have some exchanges doing three-party repos with banks. So like the very traditional three-party repos, very hard to scale, right? Like setting those up takes a lot of time. It's very expensive to maintain and so on. You have permissioned assets like BIDL that you can use, but you have to set it up as well, whitelist all the addresses, and exchanges have complex wallet structures and so on. It's hard. It's easier said than done to make it easy. And then you have players like us who can essentially provide a operationally equivalent solution to them. And that's where we're spending a lot of time in. So the treasury management, DeFi, exchanges, and hopefully then with that escape velocity, we can go into like bringing more people into crypto once we're done with that.
Fantastic. Yeah, love to hear it. I believe, I know you guys are obviously very bullish on this space. I believe USDM has over $50 million of kind of TVL today out there. Maybe just one last question to sort of close this out, maybe a prediction from you on where you see this space going. Maybe not just, I believe we have about 160 billion of stable coins out there today. Maybe give me a prediction on where that goes in 3 years or so. And then what percentage of that is in these yield bearing stable coins? Yeah.
So let's assume the US government passes stablecoin regulation in 2025. And that means stablecoins in 2028, 2029, I think are going to be the 1-2 trillion order of magnitude. And then give that 3 or 4 more years, and I think it's going to be in the 5 to 10 trillion order of magnitude. So the market is huge, and where that's going to settle, who knows? But I think 10 trillion in the next decade is a pretty good ballpark to play around with. So, and this is 10 trillion that transitioned into crypto in 10 years. That is more than has gotten into crypto in the history of crypto per year, right? So you're talking a very like a tsunami, right? Getting in, of course, depending on this very key piece of regulation, but I think is unavoidable, right? Like bucket 2 or bucket 3, we're going to have this. What percentage of that is going to be yield bearing? I think we're going to see the market is going to evolve to like an iPhone Android market, right? You're going to have probably 5 to 10% of the assets are going to be held in non-yield bearing stable coins for whatever reason, right? Like Tether invested on getting this capillarity on PIX, whatever that is. And they're going to be 5 to 10% of the supply, but keeping, call it 80 to 90% of the profits. And then 90% of the supply is going to be yield-bearing assets, kind of keeping 10% of the profits. So that to say, if you can launch a non-yield-bearing stablecoin, you would. That's why I think Bank of America is going to launch a non-yield-bearing. But in the end, the big, large size is going to be yield-bearing assets, just because that is what's needed for the transition to happen. And whoever has that asset will attract a bunch of capital that the other player is not going to be able to. So I think call it 9 trillion yield-bearing, 1 trillion non-yield-bearing in 10 years.
Fascinating to think about what that does to DeFi and some of these other areas as that plays out as well.
I think so. If you play this out and you have good ramps, predictable markets, safe stable coins with, when I say DeFi stablecoin regulation, like if you never had a financial audit as an issuer, it's very hard to touch what that means. But it's like on IFRS, are stablecoins cash? Do you value them at $1 or do you value them at secondary market price on that day? Do you pay, when do you account the entry and exit of that stablecoin? So there's a lot of nuance and a lot of like detailed stuff that there has been no guidance because there has been no regulation. So once the regulation happens, the body of accountants of their own countries will have to figure out how they account for that, how they tax for that. So there's a lot of things that need to happen for large corporations to actually like fully dive into permissionless blockchains. But imagine that happens. A farmer in Argentina is going to be able to hedge their soybeans on GMX instead of going to the CME. And the best pricing is probably going to be in GMX for the small guy because they're going to be able to forego a bunch of fixed costs that happens to participate in large markets. So, and this, I think that's going to happen. You're going to be able to create escrows for imports from China, and that's going to be in crypto just because the easiest way to create a three-party arrangement in crypto is just a 2 out of 3 safe multisig.
Right.
Like it's that easy. You just create it in 1 minute. So a lot of the flows of money should move to crypto once we get this in. So yeah, very bullish.
Super exciting to think about all that. Thanks again for coming on, Martin. If people want to learn more about Mountain or follow you, where can we send them?
So my Twitter, my X is @mcarrica. So M for Martin, Carrica, my last name. I talk about stable coins, a little bit about Argentina. I just kind of help myself and things I find interesting. On Mountain, it's mountainprotocol.com and @mountainUSDM on Twitter and X. And then for the risk discussion, terms and conditions and so on that we've discussed, we lay those out as detailed as we can, docs.mountainprotocol.com. If you have any feedback, there's an email there to share some more questions or feedback if we have not been complete on something. So we'll try to display the information so people go in eyes wide open into what Mountain is.
Fantastic.
Thank you for having me.
Yeah, thanks again for coming on. We'll put all that in the show notes. Appreciate it, and maybe we'll follow up in 6 months or 12 months or so and see how things are going.
Yeah, see how your trip to Argentina went.
Yeah, exactly. Can't wait. All right, thanks again, Martin.
Thank you. Bye-bye.